Good afternoon, everyone. Thank you so much for joining us at Apex Investments Consulting South Africa for this quarter's global investment strategy piece. I am going to go through our key views, the macro views, what we think of the progression of the business cycle, our currency views, asset class valuations, and then we'll bring all of that together in how we are currently positioned for this quarter, all the way pretty much, I think, to 31 October. And then we'll have our final review of the year with you in October. So just to give you a sense of what I'm going to cover today, as usual, we'll start with a very quick overview of our philosophy and process. So you just get a very quick refresher of how we make our investment decisions. And this time around, I'm going to go straight into the conclusions. So we will just give you a sense of how we are positioned for our first strategy, where we're bringing in different multi-asset class funds or different balance funds, but that subscribe obviously to very different investment philosophies. And then we'll go into the specialist building block approach for South African mandates. And then we'll finish off with the specialist building block recommendations for global specialist building block strategies. After giving this, I'm going to give this in a lot of detail, so do bear with me. I'm going to take a lot of time here. The reason being, when I close the global investment strategy piece, I am going to close off with the same positioning guidance, but this time around, I'm going to go straight to the point. Whereas for section 2, I'm going to try and break it down in as much detail as I possibly can. After that, we'll continue to touch on a summary of where our investment opportunities are, because we want you to get a good sense of what the global risk return backdrop looks like before I go into the argument. You would know that at this stage of the interest rate cycle, where rates are at historical highs, central banks are cutting rates rather slowly, our duration risk bet is of extreme importance. I'll spend a bit of time on that. And then after that, we will have a very quick overview of saying, how does this house view perform anyway? How has it been performing over the last one quarter? How has it been performing over the last year, to get a sense of whether it is adding value or not? So I think that's also a very quick attribution of how your portfolios should be performing before we start our meetings with you from tomorrow and the rest of this month. After that after that detailed breakdown of what the world looks like, I'm going to take you through our arguments, which is section 6. And then after that, a bit of manager selection highlights, which I think are going to be the topical manager discussions that are aligned to our risk and return ideas currently. And then, as I mentioned, section 8 is a very quick wrap up of section 2. So pretty much there's 8 different sections. I'm hoping to sort of wrap up the whole discussion around 1:15 at the earliest, and maybe 1:25 at the very, very latest. I am going to, however, try not to speak too fast, because I do know that once I get into the flow, my speed becomes a little bit high, but I'm going to try my best to keep slowing myself down as many times as I remember. Quick refresh of our philosophy and process. I think you're all very aware. My apologies, I just want to get rid of something on my screen here. You're all quite aware that our process is a systematic process that feeds into... Sorry, there's something on my screen I'm trying to get rid of, so please do bear with me. I pray that you can see my slides very clearly. Eugene and Olga, please can you help me? Is the slide deck clear from inside?
Tav, we can see your slides clear on slide 3 at the moment. So okay, nothing blocked. Yeah.
Okay, cool. There's a funny thing on my side. Okay, great that you can see. Thank you so much.
Okay, cool.
Right. Okay, great. I think you're all aware that our process feeds into 30 different mandates under 3 different portfolio construction approaches. The very first one is we combine balanced funds, effectively meaning we outsource the asset allocation decision. However, we retain control of the diversification across investment styles. We also retain control around asset classes that balance fund managers typically don't allocate to, like local property, global property, emerging market assets. And sometimes we step in with asset allocation, especially when we are positioning these portfolios for an economic recession as we have since the second half of 2022. And then the specialist block, you're quite aware, we've got full control of asset allocation, star allocation, regional allocation, and literally everything is within our control except stock picking. And then the blend is literally where we may have a client who says, I want 50% of the balanced fund approach and then 50% of the specialist building block approach. And this obviously, as you can see where my cursor is really focusing a lot on multi-asset strategies. But we also want to add that there are pure equity mandates that are systematically supported by our house view process. So pretty much what this means is that as soon as the team and the investments committee has made their final decisions across all the decision-making pillars, the tactical positioning is fed into automatically and systematically into just over 30 mandates, so much that the look and feel in terms of risk and return across our client base, across mandates is pretty much always the same. And the performance ranges are typically also usually the same. And I think you will be aware that we do not really believe at all in a one-size-fits-all approach. So for each and every one of those 30 different mandates, our strategic asset allocation is executed from 4 different contexts. The one where we're just pretty much replicating to meet the peer group's performance after fees. The second is where it's vanilla asset classes, meaning that we would not include property locally and globally. And we also would not have asset classes like emerging markets, China, and etc. And then our last one, which is our most diversified strategy, our most exciting as well. And I think typically clients can choose what they want, or they can blend this and come up with an SAA starting point that works for them. But once this has been customized, the TAA is a function of the risk return opportunities that we get when we mark to market the risk signals of our philosophy and process. You would know that as much as I'm going to focus a lot on the investment objectives side of everything today, or in the next 1 to 1.5 hours, but I'll try to be a little bit shorter than that. When we meet with you for our client investment committee meetings, we do start to find a good middle ground where we take into account what your clients prefer, and we also take into account the balance sheet risk implications at your business level. So pretty much when we have investment committee meetings at client level, it really is purely on our philosophy of partnership and collaboration, where we're trying to get the best optimal balance, the best middle ground across investment objectives, client objectives, and business objectives. You would know that when everything is said and done throughout the cycle, our goal is to be at least neutral to growth assets, to constructive, and only start to restrain our appetite whenever we anticipate a recession. And I think this is really based on our philosophical belief that usually bear markets and recessions tend to overlap. And you can see from a historical study of the anatomy of bear markets, in a non-recessionary bear market environment, you typically have 20% declines, whereas a recession-induced bear market, the drawdowns are a little bit deeper at 35%, and the earnings contraction is anything between 55 and 45. And you would know our philosophy is that prices follow earnings. So the only time we start to exercise restraint is when we are anticipating a recession. Outside of a recession, you'll find that we are pretty much very aggressive as an investments committee, where we want to run your portfolios with at least benchmark to overweight growth assets, as I'll illustrate a little bit later. Just how do we figure out when to position for a recession or not? We pretty much divide this business cycle into 4 different stages, which is what you're seeing on this particular slide. And normally, we pretty much run from the mantra that equity bull markets do not die of old age. They are murdered by the Fed, essentially meaning that you typically have a recession-induced bear market when the central bank, particularly the Fed, is hiking rates to constrain inflation by slowing down growth, which we refer to as the tightening phase. And the tightening phase pretty much becomes very dangerous for us when they lift the short-term rates, being the 2-year bond yield or the 3-month rates, above the 10-year bond yield. The 2-year being a proxy for cost of capital, the 10-year being a proxy for economic growth. And whenever the tightening becomes advanced, this is the Fed signaling that they've entered the era of measuring the bull market, in which case we pretty much quickly go into a negative appetite on growth assets. And we stay there until the Fed communicates they're done hiking rates and are contemplating a cut in interest rates. As soon as the Fed communicates they're contemplating a cut in rates, we classify that as a bounce phase. We automatically shift your portfolios back to neutral, and we stay in neutral growth assets until again the Fed gets into the business of trying to pretty much mirror the bull market. I think this particular chart, which you're familiar with, will sort of help you to also understand that we are always neutral growth assets to above, but when the recession risk signal starts to become alarming, we position for that with this underweight in growth assets. What do we use typically to monitor recession risk? These are the three familiar risks that you are aware. And fortunately for you, the current chart represents the current risk as signals updated, obviously, to quarter end. And what we love about this first chart is that it's come out of the inversion state where it is below zero, meaning that the cost of capital is now marginally below the growth rate. Another way of saying the 2-year bond yield is now lower than the 10-year bond yield. 2-year cost of capital, 3 months cost of capital, and then the 10-year proxy for growth is a little bit higher, but you can see it's not convincing enough. And our signal there would be a -1 as opposed to -3 at the peak of our de-risking process. When we look at the next one, the 10-year versus 3 months, again, not yet convincing with a score of -1. And then finally, this is what the Fed uses to evaluate the risk of a recession. And they pretty much tend to the money market and they say, what is the average money market manager expecting interest rates to be 18 months from now as opposed to where they are today? So if you take the from 3-month rate 18 months from now and you subtract it from the rate, subtract from it today's rate, if it is negative, it means that money market participants, or rather investors at large, are crying for rate cuts, which they would never do unless the economy is in trouble. So this is where the Fed has taken it too far, and the market is saying these rates need to be cut because the economy is weakening, and you can see right now that is not looking good. And because all of our 3 recession risk signals are not giving us encouraging signals, if we come back to this place, we'll be in what we call a euphoric state. And if we come back into this chart, this would be sort of signaling we're expecting a bear market of some sort. So obviously recent market developments on the back of a concerning labor market report would justify or vindicate our position to say still this is not a time to be comfortable with risk, specifically developed equity market risk. And then you would know that it's one thing to de-risk your portfolios, but you need to have a plan. How do you get back into the market? Because as you would know, investments is about time in the market and not timing markets. So we've got 13 re-risking criteria, which we follow. I mean, to give you a very good sense, if you look at point number 2, when the Fed communicates a pause in interest rates and starts to talk about rate cuts, at that particular point in time, we immediately maximize duration risk across your portfolios. And then when the Fed has its first cut rate, we add duration risk via calls like property. And then when the dollar peaks, which typically happens when the interest rate differential between the US and the rest of the world is exhausted, which is another way of just confirming that the currency market or the dollar believes the Fed is done, the dollar will stop strengthening and start to weaken. And again, this is where we'd start to add dollar calls, which is asset classes that do well in a dollar weakening phase. And this includes gold, emerging markets, China, and et cetera, and et cetera. I do know we've gone through this in a lot of detail, so I'm not going to take you through the rest of it, except to say you can see that point number 5, which is the yield curves inversion reversing, that hasn't yet happened. But if you look at what we want to do, where my cursor is in the last column, when we start to be convinced that these recession signals have unwound, we would automatically move into a pro-growth asset. So for example, we would hope to be 5% overweight South African equities, 2% overweight South African property, 2% overweight global equity, 2.5 overweight global property, overweight global credit. Really just saying that when we don't see recession risk, we go all in. But obviously, this is going to be subject to valuations, and you do know we look at that. The second signal that is not yet allowing us to take on risk is the stock to bond market ratio. it really is a derivative, to be very honest with you, of section number 5. So it is not a surprise to us that this is not yet triggered, and I'll take you through the detail of this. And I guess these are the only two reasons why we remain very skeptical around risk, specifically developed market equity risk. The reason why we sort of go through this regime-based asset allocation, as you would know, based on any study of equity market cycles, if you divide those into 10 equal parts, take any equity market cycle from start to end, divide it into 10 different pieces. Typically, the strongest performance comes at policy inflection, when the Fed communicates they want to start cutting rates, when fiscal policy communicates it now wants to shift to increasing growth, when there are also extraordinary measures like quantitative easing. That's typically when the market has this aggressive rally that you don't want to miss out on. So typically, as soon as we start to hear of policy announcements, we automatically position for the first decile and we wait there. And once there's confirmation, we shift into overweight. Normally, if you cash this very nicely, the performance itself will shift your portfolio into overweight, that you don't need to make that many changes. The deciles in between are good. It's expansionary, but you can see it's very muted. And then the last decile is the second sweetest, but it's ultimately the most dangerous. I mean, this is where you can lose quite a lot of money. And you'll recall in April and May, you lost about 20%. If you're overexposed to DM equity because they are euphoric, they've gone back to where they were when we met you in April. And again, they were very, very careful. So whilst this is the second sweetest part of the cycle, we don't like to participate in this because of the downside risk that it comes with. As it would be when you classify our positioning from this particular context, which is the center, which is the gravitas of our philosophy and process, the ideas where we are positioning for the first decile still is South African equities, which started to do very well on the back of the political suspicion that would have a government of national unity. Chinese equities, which were triggered by the policy announcement in September of 2024. EM equity, which is catching a beat from Chinese equity and SA equity, but also the peak of the dollar. Global property, which we believe is still to benefit from the cut in rates, which has not been happening that fast. And I think the list goes on, but essentially we are strongly convinced that these particular ideas are still experiencing first decile performance. We believe gold, South African property, and Japan are experiencing more expansionary type of performance. And the ones in red is where we're still very, very cautious and we are underweight. We think that the performance is going to be great, but it comes with significant downside risks. So I think the close to equity markets on Friday, based on the labor market report, and maybe even on the Fed decision to not cut, I think is explaining some of the weakness we're seeing in DM equity, which is exactly what we expected. So if these asset classes in red sell off more than the asset classes in green, which has been happening even up to this morning, then I think your portfolios are going to continue to have a very good year. And obviously, when euphoric assets are doing very well, we tend to struggle because we are not fully exposed. And it is by design. We're not going to be greedy for areas in red, but for things in green, absolutely greedy and without shame. Now, let's look at portfolio positioning for this quarter, which is pretty much going to be effectively from now until we see you again. Literally, I think it's going to be on the 31st of October or the 1st of November when we're going to have our next session. So in that 3-month period, we haven't really changed our thought process as far as the portfolios which only invest in balanced funds, except to say that in response to the policy inflection in China in September 2024, we introduced an additional TAA weight of 2.5, taking the exposure to the prescient China Balanced Fund to 7.5%. And we communicated that as far as China is concerned, we want to harvest as much of this first decile as we possibly can. We have managed to harvest a little bit of it in the H shares, the Hong Kong listed ones, which is predominantly China tech, but not quite in the A shares. And there we are still positioned with a lot of greed. And as I mentioned earlier, with no shame whatsoever. And we are waiting for more policy announcement for traction in growth, traction in earnings, traction in consumer confidence, traction in business confidence before we can take our last bite of 2.5%. And remember, this is the point where we are greedy. So we really want to take our Chinese allocation to 10% in the present China Balance Fund. The good news is that sometime last week we were starting to hear some rumors of good policy developments coming out of China. I'm going to share that with you later. So don't be surprised anytime between now in the next few days or weeks, we send you an email to say we're taking our last and final bite of 2.5% in the Press in China Balanced Fund for these specific strategies and taking that allocation to 10%. It is a really, really good time to take advantage of that policy inflection, great valuations, and etc., as I'll take you through later. So because we are still positioned for a recession, because the recession risk signals are flashing red, as I showed you earlier, we pretty much underweight the growth managers like your ABEX, quality like your 91 Opportunity, value, for example, like the M&G Balanced Fund, Coronation Balanced Plus, Allan Gray Balanced, momentum like Matrix, Gales 91 Managed, and Market Beta, your net group fans, your Satrix fans, your 10X, your 1X, etc. And pretty much there we are pretty much having this underweight allocation. But when we had the 20% sell-off in DM in March or April, we got greedy. You do know when markets sell off, we come in like a rush. And there we bought in 2.5% into DM equities. It worked very well for us. Those equities have rallied back to where they were before we got in. And we actually quickly got out of that profit and we went back into the defensive block of South African bonds. And as you heard from me, we are now waiting to deploy that money out of South African bonds into China, into the Chinese Balance Fund. And that's pretty much how we are positioned for this mandate. The specialist building block strategy, what I can say is that we are in the higher for longer investment strategy remains our base case view. So if you think about higher for longer, it can play out in three different ways. It can play out as implied by option one, where interest rates are too high, the economy is taking strain, consumers are taking strain, business is taking strain, and however, the Fed won't hike rates any higher. So if that is the case, because we've been positioned in this way since 2022, we don't really have to fiddle with your portfolios that much, except of the occasional 2.5% tweaks like the one I've just talked about. The second option when your rates are at elevated levels is that inflation surprises to the upside, and you realize that you wake up and central banks actually say, well, we are no longer going to pause, we're actually going to hike further, or we're going to hike higher from high levels. In this particular case, if the risk is that inflation is going to continue to get out of hand, if you listen to me very carefully, we are very aggressive on duration risk because the rate hiking cycle is at its end and we are sort of in a slow grind lower. But if that direction changes to the upside, a high duration risk strategy will suffer a lot of losses. In that case, you need to quickly reduce your duration risk and increase your low duration risk exposure. You'd also maybe need to reduce your conviction around growth assets. We're not convinced we have to consider option two at all. And I'll touch on that a little bit later. And then option three is just where, although you won't have the stress of further rate hikes, the speed of rate cuts is too slow that it stresses out a bit of the growth asset story. And remember, it's one thing for interest rates to be high and there's no recession risk signals flashing red. It's another when rates are high like today and your recession risk signals are red. In this case, you really want to be a little bit careful around your growth assets. You also want to be super careful because there's also the mantra, there's also the school of thought that typically US equities are more defensive than global ex-USA in a deep recession. So there you want to be a little bit careful around your tracking error towards DM equities where you don't want to make it too big, but you don't want to make it too small. So it's a bit of a difficult balancing act in that regard. And what we have done to make sure we play into this balancing act that I'm trying to explain with such difficulty is you start to nibble into developed market equities, which could potentially do well in a recession, like Japanese equities, because the yen is a defensive currency. Usually in many risk environments, the yen does extremely well. And to the extent that it is the cheapest currency in the world right now, you want to buy into that. We also have very good valuations, a very good policy stance in Japan. So there's a part of us where that 2.5% we're taking out of DM equities, we want to nib a little bit into Japanese equities and or global small mid caps because they're significantly cheaper than your mega caps. So that's pretty much how we are thinking around this particular strategies. And obviously, we are going to remain defensive for reasons I've already mentioned, very yield conscious. I mean, what better time to lock in good yields than at the peak of the rate hike cycle? Caution around extreme signals. You saw those recession risk signals flashing red. Don't fight the Fed. If they indicate they want to hike rates further, we will position our portfolios accordingly. Don't underestimate President Trump's policy communications. He's now shifting slowly into tax cuts. He's shifting slowly into deregulation. Small mid caps are going to be the best beneficiaries of that. Hence, us starting to be a little bit greedy in the area because the policy inflection may suit that kind of thing. And then finally, do not fight Chinese policymakers. So sometime last week, if I can share this now, but I'm going to repeat it maybe 3 or 4 more times because it is something we're very excited about as a team. So sometime last week, our Chinese policymakers came out and say, woo, this lack of consumer confidence is a concern because it means there's deficient aggregate demand. And whilst we look like we're in control of inflation, it really is because we are not seeing enough spending. The business in China is too cautious, consumers are too careful, confidence is super depressed, and they've literally said this is an economic it's an economic stability risk. And they've also gone as far as calling it a national security risk. And many of you would know that if there's one thing Chinese policymakers do not play with, it is a compromise to national security. And they've communicated that they will be releasing policy to address this, and it must be implemented urgently. So remember, we say that when we hear about these policy inflections, we become super greedy. So we want to see if there's going to be more details around this in this month of August. Our expectation already is that we're going to have another good news coming out of China in September 2025, as we had in September 2024. And we're going to take our China allocation to 10%, and we stop there because there is a limit, obviously, to which we prefer to be greedy. And then other things we're thinking about as far as the specialist building block strategy, we want to see successful execution of pro-growth and pro-business policies in the USA, which obviously explains this interest in small mid caps of 2% that we're starting to have. I think President Trump is getting to the end part of the whole tariff story. And at some point in time, he's going to have to shift and start to move into deregulation because remember, next year, they're going for their midterm election. So he needs to have the win of deregulation and tariffs to get onto the campaign trail. We're not going to wait for that campaign trail. We're going to position for it because it is part of the policy inflection and macro regime we look at for risk appetite management in our portfolios. Pillar number 2, which is the reversal of recession risk signals. I've already alluded to this. This is not yet the case. When it happens, you're going to see us starting to push for more aggressive mandates, but we're going to be very patient until that happens. Pillar number 3 is our currency risk, where we're anticipating a continued weakening of the dollar, which we've classified as stealth weakening in the sense that although the trend is grinding lower and lower, it is volatile, where you've got maybe like 6 months of weakness like we've seen since January until like maybe maybe from January to the first weeks of July. And in the last 2 weeks of July until today, you saw the dollar starting to become strong again. So it's a bit of a volatile weakening cycle. But generally, we've made a call that the weak cycle has begun and we're positioning accordingly. And then finally, and as far as valuations are concerned, DM and US are the most problematic. We got a little bit of improvement in March and April. Unfortunately, they've rallied back to very problematic levels. We took our profits as greedily as we could, and we locked them in somewhere safe, and we're waiting for the next area to pounce on, and clearly China is inviting us, an invitation we shall gladly accept across the portfolios. And then our 3 high conviction ideas remain South African equities, South African bonds, and Chinese equities. I don't really have to say much about China. I think you kind of know what our stance is, but let's just unpack the China story a little bit further. A lot of our discussions and conversations with you are normally always focusing around a correction, and we would say a correction by definition is a loss of at least 10% but not more than 20% over a period of roughly 3 months. And then we would make comments like a bull market is when you now enter into the 20% plus as far as losses are concerned. And you will remember when we met you last, I think in April, was it? If not, it was probably in February when we're saying we're anticipating a correction. And if it happens, we're going to buy in super fast. What we are starting to see is a term we've never bothered to describe in our global investment strategies, which is the bull market. The bull market is a gain of at least 20% from inflection point. You would know the policy inflection point for China. The one that really nailed it was the September policy inflection. And when that happened, the H shares, which is the dark blue line, which kind of looks black, has rallied, I mean, from a low, and it's currently now sitting at 118 if you rebase it to 100, meaning that it's 2% away from entering a bull market. So think about it. When it enters a bull market and there's policy inflection behind it, it gives durability to the bull market. When it enters a bull market and there's valuation support behind it, it also means that is more enduring, to the extent that in China, we've got great policy stance, great asset class valuations, great currency valuations, great diversification benefits. If we officially enter bull market territory, that 2.5% I've been talking about is a clear in. The A shares doing very well, very disappointing, but fortunately, I think we've got a strategy of a 50-50, where we 50% H shares and 50% A shares. The technology shares obviously got the additional boost, that additional technology boost in February of this year. And the A shares are a consumer story. And I'm going to unpack the China consumption cycle in maybe 10 minutes from now. But the most thing I'll leave with you here is in CNY terms, if you kind of look at where my cursor is, we're almost entering bull market territory. And then in Rand terms, we pretty much just cut into bull market territory on the 31st or the 30th of July as far as the H shares are concerned. And we are kind of like 10% away as far as the H shares are concerned. But you can see that the excitement, that macro regime shift, that macro regime asset allocation, we really very excited about this. So do expect an email from us when the time is right. Things are not always great. They always paint trades in a portfolio. And our view is that we are a multi-manager. We run different strategy, different asset classes for very different reasons. As you would expect, we have been positioned for recession risk via our overweight allocation to DM bonds, and there hasn't been a recession and they have not rallied. We've also been positioned for a great rate cutting cycle via global property, which also does well when bond yields are rallying, because your bond yields have not done well because there's no recession, and your property as a result has not done well on the global side, and that's another pain trade. Global commodities do very well as the Chinese economy is recovering. They do very well when the dollar is weakening. That is starting to happen, but it's a very messy transition. That's another pain trade. And we'll typically say to clients, we love areas in pain trades where our conviction remains very high. So please, when we come to report with you, those are going to have red numbers in your portfolios. Please do not stress us around that. We're still very optimistic. But if you cannot hang on, we would then say, look at the position size in your portfolio divided by the investment horizon, which is typically 3 years or 12 quarters, and you get about 42 basis points, which we offset to 50 if it's a 5% allocation, 75 dips if it was a 7.5. And we would say maybe cut back on a quarterly basis, like 75 basis points every quarter until you get to half. Wait. And then if the idea starts to gain traction, go back to the house view weight. We hate giving up on ideas. We hate regret risk, especially when our story is playing out nicely, but taking a little bit too long. So they would say, please hang on. So when we summarize our specialist building block, first of all, we are experiencing pain in the sense that DM bonds, I've already mentioned, are not doing well. DM IOBs are not doing well. We've got about a 5% exposure to 10%, 5% on the local side, 10% on the global mandates. DM real estate, it's not going to do well if bonds are not doing well and there are no rate cuts. So we understand that. SAIOBs, everybody seems to think that you only buy into this when inflation is a problem. South Africa has been delivering very good inflation news. So no one actually really cares about SAIOBs, although the real yields are super attractive. Global commodities have been a messy transition. When I met you, I think last quarter, we're so happy and we're bragging around how it has done well. This time around, we're pretty much ashamed because it's kind of reversed all the gains, and I'll show you that later. And then quality managers and growth managers in our portfolio are really, really suffering. But we understand the reasons why. We are underweight a lot of these ideas anyway. So you are going to see that any manager who makes use of these ideas, when you look at your x-rays, is not going to give you a good number. Hang on, it is part of the story. We're still overweight duration risk, although it is a pain trade. So I'm not going to go to 0.3 and 3, 0.2 and 3 any longer. We want to add to global property. We want to add to local property because your yields are still elevated and have got a long way to go. Rates are still very elevated and there's more rate cuts that can still come forth. The valuations are good, very limited refinancing risk. So we love property, at least neutral, and we are sort of itching to get into overweight. We did mention when we are greedy and obviously when we are not. EM, we are neutral across all of your portfolios. The dollar has peaked. Dollar weakness is good for EM. You saw how EM has trashed DM so far this year, but let me not get ahead of myself. I mean, there's still a good 5 months to go this year. The earnings have bottomed out and are improving really nicely. I'll show that to you later. Central banks are cutting. I'll show that to you later. They're globally under-owned, which means if capital moves into EM, they can really just rally very explosively. The global manufacturing cycle has bottomed out. Typically, it is driven by policy change in China, and I've already given you a hint of how they're thinking. So there, you don't want to be caught out on the underweight side because everything is well aligned. Although the valuations start to look a little bit like dear now, it's because the markets are pricing in an earnings recovery, and that is our expectation too. Underweight DM equities, overweight DM bonds. You know that we wouldn't be in this position if the recession risk signals was no longer red. It is still red and we are not moving. And that's the pain trade, actually, point number 6. Japanese equities for the cheap Japanese yen, great policy stance, great earnings expansion. So we have added a little bit of a 2.5%, but only because we want to protect ourselves from this underweight DM equities that can bite us if DM equities continue to excel regardless of the expensive USA exposure. Global small mid caps, we're starting to sniff into a potential policy shift by President Trump from tariff war, tariff irritation, and etc. into deregulation and tax cuts. And we already saw from the Big Beautiful Act, some of the tax cuts are established, and then now just deregulation to come. Risk appetite towards South Africa, EM in China. I think you know this one. I'm not even going to go through that any longer. But for China, we're going to continue to keep a 50-50 of H and H shares. Gold, we still love. I've been on this story for a long time, so I'm going to spare you that repetition. And then thematic plays is global gold. There we repeat again. Global technology. This story is difficult to gauge its beginning and its end. We're not going to be the ones trying to be smarter than everyone else. We're just going to copy peers and keep a healthy exposure to this particular one via growth managers. And obviously, the recent drag by global growth managers has worked against us. And commodities, we love the greenification story. We love the limited supply that is in that space, and the fact that there are already signs of supply constraints and the dollar is weakening, real is about to go down, China is about to improve. You can give all the list there. And then finally, our onshore versus offshore for this strategy is our neutral exposure of 30% if you do not bring China in. Otherwise, it's 35 to 37.5, given that we're sitting with China at 5 to 7.5. I talked about that policy inflection that they've communicated in July. If it's confirmed again and they follow up on it, then the Chinese allocation is going to go up to 10, in which case our offshore exposure will become 40. I think that's the highest we're going to go in the absence of a serious and significant pullback in DM equity. So this is pretty much the guidelines or the for your positioning for specialist building block strategies. Put it in a visual picture. Neutral SA equities, we don't want to be underweight or overweight. Neutral property, same story. A little bit of greed on SA IOBs and nominals because of juicy real rates, and that is obviously being funded by cash or your lower duration risk. Also partially being funded by DM equities. I did talk about how we locked in some of the profits and transfer them straight to South African bonds. EM equities neutral. We don't want to be underweight or overweight. Chinese equities, we're greedy with an overweight of 5. You heard me, it's going up to 10 very soon. DM real estate neutral, DM IOBs neutral, DM nominal neutral. This was overweight if you remember, but it's been taken out so we can make room for the small global small mid caps, and also to some extent for the Japanese equities. Credit we still don't like, cash we still don't like, and then gold we absolutely love. And then if you look at global portfolios where we're managing global low equity, global medium equity, global high equity, global flexible equity, and pure global equity, where there's no South Africa in those mandates, the slant and the risk appetite is the same. So I'm not going to really bore you with the detail, but the character of portfolios is definitely quite similar in that area. Before I finish off on our positioning, I'm just going to quickly take you through BCA, Bank Credit Analyst. This is our independent investments research provider, giving you a sense of where they're positioned. I'm going to focus on 3 main areas. I'm going to focus on what their consensus view is. So to give you a sense of how to read this, global equities, for example, they're underweight. But if you think about the positioning for global equities in a team, it can be underweight, it can be neutral, it can be overweight, it can be get rid of them, as an example. So those are the 4 states in which you can make thoughts. So when they say the strategies consensus here, they're saying there are 17 strategies within the BCA that vote towards global equities. And of the 4 states being underweight, neutral, overweight, get rid of them, the most popular one was the underweight one, and 9 people voted for that, which is about a 50% conviction. So it's a 50-50 within BCA, this global equity story, meaning that there is enough of them that want to be neutral, and there's enough of them that want to be overweight. That's sort of how you can think about it. And if you look at it in that angle, our grid towards Japanese equities and small mid cap starts to play into this weak consensus as far as the BCA is concerned. The last column is subscribers like us who also vote. And you can see many of us are in agreement with the underweight equities. It's a 50-50 as far as DM fixed income is concerned. And actually on the 18th of July, this was overweight when I met you last time. This is now neutral. It also pretty much explains why we are pretty much also now neutral when you look at DM nominal bonds for South African mandates, but obviously not like that for global mandates where the number of ideas is not that many. Cash, the BCA is neutral. It's a poor consensus if you look at it, 5/17. That means that they really want to do other things but neutral. But it looks like asset allocators like ourselves who are subscribed to BCA love this call. I mean, it's one of the highest majority calls. If we move on to the regional allocation, you can see that the consensus view in the BCA is a neutral, but the consensus is quite weak. You know, it's 6/15, meaning that there are a lot of people that would rather be underweight the USA, and there's also a lot of those strategies, 15 of them, who would rather be overweight, and etc. And as far as the subscription is concerned, you can see this is not a good, this is not a nice vote of approval, meaning that many of the subscribers would either be underweight or overweight, but we don't know what it is. As far as we're concerned, you know, we are in the underweight camp, so we would have been in the disagree camp of 80%. European equities neutral, a very, very terrible consensus, 4/15. But funny enough, the guys who subscribe to BCA love European equities for whatever reason. Japanese equities we're starting to buy into, but only 2.5%. They are neutral. You can see this is a 50-50. But as far as subscriptions are concerned, we are pretty much in the minority, 45%, whereas 55% disagree. Emerging markets, we are at least neutral. We love EM, we love South Africa, we love China, we love. It's a neutral exposure. There's a very high conviction. Well, I'm going to say very high. 1, because of a bias, but 2, because 10/15 is clearly better than 7/15, much better than 4/15, and certainly better than 6/15. So from a consensus perspective, this is one of the more favored areas within the BCA, and the subscribers 55-45. Well, borderline almost unsure, but sure, I guess is what you can say. But again, remember that we are neutral, so we haven't expressed a lot of greed. And I think it's sort of in line with this this external independent view into our risk appetite. Government bonds, fixed income. This is where BCA is saying between government bonds, investment grade, and high yield credit, what do we prefer? And across those asset classes, they would rather be in government bonds, and that's a very healthy consensus. And underweight credit, which is exactly where we are, and there's no doubt about how everyone else that subscribes to BCA thinks this is the way to position, and we can confirm that's how we are positioned across your portfolios. The dollar, we called for a dollar pick in Q4 2022 when we bought gold into your portfolios. And then we called for a dollar weakening cycle early July across the investments committee. I think you got emails from your portfolio managers. And then BCA got a consensus change on the 18th of July, calling for the beginning of a prolonged dollar weakening cycle. The conviction there is a 50-50, but subscribers love this call. It's an 80% majority. In terms of the euro neutral, poor conviction within the BCA, but I guess okay with everyone that is making use of their research. The Japanese yen overweight like us, one of the best convictions. So we feel good about our call, and subscribers are sort of in agreement. So on the currency side, we're on the right side. On the asset class side, not quite. EM currencies, I'm not going to talk about the love story we have with this particular asset class, or have had with it for a while. It's been a prolonged pain trade, but we do hope we are out of that. BCA believes you should be neutral towards EM currencies. It's a healthy conviction. And I think also a few of the subscribers prefer this particular course. So this is just an independent check on the house view positioning we have for your portfolios. Commodities, not exactly the best place across the BCA, but on the gold side, it's an overweight, very great conviction, 11 out of 13. And the subscribers absolutely love this. So if you just bring in that independent view into our house view, which I'm going to summarize via the investment ideas matrix, pretty much we are aligned to the BCA, where from a geographical perspective, we don't want to take big bets away from USA, DM excluding USA, etc. But we want to classify that we are neutral USA and DM specifically because we are underweight the equities and overweight the bonds and the cash. That's the only reason why we are neutral. But for everything else, we are neutral, especially at the growth asset level. So for your South African Regulation 28 portfolios, where there's a foreign allowance of 45%, we would pretty much be neutral in South Africa. And we would also be neutral all the offshore ideas. From an SAA perspective, our neutral foreign is 30%. Meaning that you're not going to see anything higher than 30% foreign in any of our portfolios unless it's explained by the 2.5% Japan I talked about earlier and the 7.5% China that we want to take up to 10. These are the only geographical regions where we would be a little bit greedy, but not necessarily the rest of them. So I think that's pretty much where we are in your positioning. And then if we move on to asset classes, what you can see from this chart is that there are too many ideas calling for an underweight TAA stance. So pretty much from 5% to 10% underweights, we've got way too many ideas. It's almost like a scale tilted to the downside. This is a very good way of saying when we look at asset allocation, risks are currently tilted to the downside, especially on the areas with negative areas. And the only way we are offsetting the downside risks we're seeing across DM ideas is obviously via the exposure to DM bonds, DM IOBs, and gold. Otherwise, we prefer to take on a neutral risk. So it's not a good environment if given the high number of opportunities with a negative TAA risk score today. And then if we look at it from an investment style perspective, a very negative skew again. So this is just saying to, as far as positioning is concerned, we're not seeing a lot of exciting things. There's not a lot of things popping up on our positive TAA score, and automatically that means we are cautious and marginally greedy where it matters. And I think you kind of have a sense of how that is playing out. And then finally, fixed income duration risk. You would know that I've taken you through this whole investment universe, but I've left out the non-equity part of your strategy, which is a fixed income, where if we're about to enter a rate hiking cycle, we would eliminate duration risk. When we are about to enter a red cutting cycle, we maximize duration risk, which is where we are. So we love high duration risk across all the portfolios that we are managing. And this is a manner in which we can blend different fixed income products to achieve different ranges of duration risk. We would then compare these blends of duration risk to the strategic risk weight for the different mandates. So a low equity portfolio, for example, has got a neutral duration risk of 4.55 years, but we want to be overweight by at least 0.5 years, which would then be 5.05, up to 1 year, which would then be 5.55. If you look at the blends here and you're looking for a 5.55 weight, it can only be achieved in 3 scenarios, which is where my CASA currently is. And that's pretty much how we would then structure the fixed income carve out of your portfolios. And then this is the same thing, but on the global side, but I'll spare you the detail of that. And then finally, on performance, what has been happening across your portfolios. Gold miners have done very well, so that's pat on the back for us. South African equities have done very well. We are neutral, those ideas. We also think we've done very well. South African property, we're neutral. So we pretty much, I think, been in the money as far as your investment mandates are concerned. Let us be honest as well. When you look at the tail of performance in the last quarter, global commodities, you had me brag about them. Clearly, that's backfiring so far, but we're calm. We hang on. It's going to work out for us. So that's a loss of 6%. Not a good thing to go through. Global inflation linkers, a loss of 3%. Not a good thing to go through. Chinese A shares, you had me brag about them earlier. In this quarter, they were a serious disappointment. Global property, global bonds. So this is our pain trades. But if you think about it, this is where, in the absence of rate cuts, in the absence of a pure recession, some of these are not going to do well. So it is sort of expected. But I want to end this note on saying, as much as global TIPS, which is inflation linkers, and global bonds have not done well this quarter, remember, we reduced them by 2.5 in March and April in favor of global equity. So if you look at the global equity performance of 8% and the global inflation linker loss of almost 3%, there's 11% gain we locked in for you by making that TAA course. So on that point, we did very well, but let's be humble enough and also say there are areas where we just pretty much trashed the performance of your portfolios, but obviously not intentionally. And then if you look at it from an investment style perspective, we love this mix of local, global. I think it vindicates us. We have said we're not going to call the AI story or growth managers, so we will keep an overweight just to be safe in case it plays out longer than we're ready for. That's working out. You've heard us talk about global small caps for quite a while now. If we look at where they are, that's also working out. So we're very proud of ourselves from that particular angle. And then if we move on to peer group, I think this is just looking at it from more a South African mandate story or classification. I just want to say that the inflection point for global commodities is such a mess. It's so painful. It's annoying. It's boring. It's everything. But we're still very convinced we've done the same thing. So that's the one thing I'll quickly touch on. I mean, it had to be last. It's better if it's kind of hiding somewhere in the middle. And then DM bonds, DMILBs, and DM global real estate. This one, I think I've been explaining for a while. So I'm going to save you that. From a 1-year perspective, however, gold has done very well. Chinese H shares have done very well. Chinese A shares have done very well. The 50-50 blend of China H shares at 34%, China A shares at 17%. Divide that by 2 gives you 25%. It's actually done better than SA equities. EM equities, you can see they're doing very well. So pretty much, I think over the last year, we really have done very well here, and we're very proud of it. Obviously, until you start to look at those, yeah, you know them, those guys. And then if we sort of move on to investment styles, the idea that we are neutral South African equities and underweight global equities cannot be supported any better than by this beautiful chart. So we're very happy here again. And then if we finish off at the mandates, I can just say, look, our calls have actually done very well in the last 1 year. We feel a sense of relief. But 5 months to 31 December is a long way to go. Anything can happen, but so far, so good. And then if we bring it back into this is how you're positioned. And you saw that everything in green has got a very good 1-year number, excluding global commodities, and most of the things in red have not really done well, with the exception of growth, where we've been a little bit restrained in expressing our underweight. About 75% of our calls have done very well, so we're very thankful for that, and also thank you also for giving us the opportunity. So it's been a great quarter. It's been a great year. It's actually been a great 2 years as well. And if we really have a great year, it's going to be a great 3 years. So we're waiting in great excitement and anticipation. I'm now going to quickly take you through our views. I think I'm still on time, so I did promise to sort of cut off by 1:25 at the very latest, and I think I will make it to that at that time. So let's start off with a global macro picture. You will not ease is the theme of Pillar 1. On the one hand, somebody has increased tariffs to the highest level we've seen in 100 years, the Centurion. And then we're not going to use names today. And then somebody also refuses to cut rates. So essentially, it's a story of he will not ease. Both of this stubbornness, both of this resilience is not good for global growth. It's not good for recession risk. It's not good for our growth appetite. So this whole he will not ease story is not a nice one for us, but that's our theme as far as Pillar 1 is concerned. And then let's take it a little bit further and try and see how he will not ease. On the one hand, it's this aggressive tariff war. On the other hand, he's got the One Beautiful Bill Act passed, where there's some tax cuts will be retained. And I think they're going to spend 0.8% more on GDP or fiscal policy this year because of this bill. The problem with that is if you look at the area, the chart where my cursor is again to the right, the fiscal risk for the USA is not in a good shape, and it's about to touch the famous 1 sigma line, but this time around in the wrong direction. This chart is just saying if we take the 10-year bond yield today and we subtract growth in the USA, it gives us a sense of whether that debt is sustainable or not. Right now, the growth rate in the USA is much lower than the cost of that debt, and it's about to hit the dangerous 1 sigma level. So this borrowing is happening at the wrong time. And because it's happening when the fiscal risk is so high, your bond yields have been range bound, and hence our DM bond call is not working. Our DM IOB call is not working. Our DM property call is not working. So we're not happy with this he will not ease scenario and outcome. We're also very tense. If you look at this, most of the times you have a financial accident in history, it's because your bond yields are trading in a range-bound area at dangerous levels. So we really want this bond yield to rally. From a performance perspective, absolutely. From a recession risk perspective, we're trading very close to financial accident territory. So this is a very tense macro environment if you can sort of think about it in terms of these 3 diagrams. And then if you look at it from an inflation perspective, the tariff story means that the CPI swap market is now expecting inflation to increase from 2.7% to almost 3.5%. That's almost like 100 basis point increase, almost. I think it's about 80, which is not a small number, but all it means is that it's going to make it very difficult for the Fed to cut rates. It's going to make it very difficult for these bond yields to come back into safer territory away from financial accident. Mortgage rates, which track the 10-year bond yield, are also elevated, meaning that the consumer is heavily laden with pressure. So again, you can't expect to escape recession risk when he will not ease. And then current studies by the Aston Business School of Canada, I took you through this last quarter, maybe the previous quarter as well, is that under a retaliatory environment, the inflation picture ends up being terrible for North America, being USA, Canada, Mexico, and actually deflationary for the rest of the world. But you would have noticed in the recent trade deals, it is just a case of the US imposing tariffs. Everyone else is no longer retaliating. Remember the example I gave you? If you slap someone with tariff, it's like you're slapping your own child, and you're saying, I can slap my child better than you, which is kind of really silly. So in a lot of the trade deals, we're seeing that the US is the only one slapping their child, meaning that if inflation is high, your real wages in the USA are possibly going to end up lower, so which is not a good picture. And I think that's the argument that the BCA is sort of giving, which is why they have this whole CPI swap market story. It just means disposable income in the US is going to crash, and the list goes on. Another way of reading this is Alpine Macro, we're sort of saying, listen, imported consumer goods, which is where this whole tariff story is playing out in the USA, that's only less than 3% of consumer expenditure. A lot of consumer expenditure is in services, specifically shelter inflation, which is elevated, and it's expected to decline substantially going forward. So they're saying the tariff story is almost like not a point of conversation for US consumers because it's too small a part of their bucket. And even if it was big, it is possibly going to be offset by the declining shelter inflation. So from that angle, the argument I have here and here is squashed. It doesn't make sense, but it depends on which argument you're going to follow, obviously, for portfolio construction. However, when it comes to US companies, tariffs would affect 17% of their imports, so it's a big deal. But 17% is not a big number, they say, because if you look at the current tariff rate going up to 20%, 17% of that 20%, I think, is about 3.4%. And they say American companies go through much bigger shocks on a day-to-day basis. So 3% in the bigger scheme of things is not something they would want to pass on to consumers that is that fast, because they can sort of absorb it and they can manage it via a lot of other options. However, Alpine Macro also says if you look at the growth tax, which is essentially the combination of the dollar, interest rates, and credit spreads, it is quite low and has been declining so far this year because of the weak dollar. This blue line is inverted. So when it is going down, it means growth tax is increasing and it tends to drag the S&P down with it. But when it is going up, it means that there's upward pressure on the S&P. So they're saying even if there was a lot of pressure on tariffs, the benefit of the weak dollar so far this year, low oil prices and low credit spreads, means the US economy has been experiencing a growth boost so far this year. So the recent surprise GDP numbers are not a surprise to us if you think about it like this. So it kind of means that the tariff story is not yet something to worry about. They also make the argument that a weak dollar is very good for earnings growth in the USA. And again, because of this weak dollar, we may have an earnings boost. And so far, the earnings results are generally okay. So you get a sense that a lot of the arguments that are very easy to build up concerning tariffs and the Fed do not yet feature into risk appetite conversations. But it depends obviously on what you think. You would know that we don't like to get caught up in one view. We bring all the views together by analyzing data. So if I just finish off the macro picture by looking at data, because I mean, who do we choose? Do we choose the BCA argument? Do we choose the Alpine Macro argument? Which one is going to make money? All of those things are very, very confusing. But if you bring it into data, the picture becomes clear. First of all, growth, which is our appetite for growth assets, the black line has been quite negative, I think, since Q3 2024. You can see that it crossed into the negative line and continues to trend lower. And because this is trending lower, when our recession risk is flashing red, we are concerned about growth assets. Geopolitical risk, which is economic policy, is not making it any better. So maximum uncertainty and growth is weakening. Inflation was about to make it better, but those arguments suggest that it might deteriorate. And then the yellow line monetary policy is not yet helping. So from this particular angle, you're not really seeing a good picture for growth on a forward-looking basis, and it vindicates our views so far. Let's take it a little bit further and we look at growth in the rest of the world. China has been the black child, really went through 3 lockdowns, crazy that. It has since stabilized and we're expecting another push up. I'm not going to repeat what I went through. And you can see from a growth perspective, Japanese growth is actually the healthiest. Policy settings here are great. And the yen is so cheap. And I think you heard about our Japan story already. So I'm going to rush through this so I start to catch up with time. And if we move on to inflation, South Africa and China are looking great. But the honest truth is that both of these countries have got very high unemployment rates and therefore aggregate demand. South Africa is solving the deficient aggregate demand via structural reforms, which are very slow. And then China has mentioned that it's starting to treat that as urgent. And we really, really, really love that. And then Japan has got the highest inflation, but they're not hiking rates, meaning that they're keeping aggressive real rates in the negative side. Monetary policy, Japan is the best. We talked about those very good policy settings. The rest of the world is in negative space, and USA being red and South Africa being green have got the most aggressive monetary policy stances, meaning that there's a lot of room to weaken rates or to cut rates if inflation continues to behave in both the USA and in South Africa. When you've got a lot of room to cut rates and your bonds are cheap and your real yields are juicy, you maximize duration risk. So from this particular picture alone, we're very happy with our duration call. From the Japan call, we're happy with our recent allocation of capital into that region. Fiscal policy, USA was kind of holding forth. It's kind of weakened, but because of the Big Beautiful Act, you'll see the numbers reflecting that when we see you next quarter. And then first emerging markets, this is actually China, to be honest, has been quite aggressive. But generally, we're in a world where there is a rush to spend money in the USA, the deficit approaching -8. Another rush to spend money in China, where they actually are probably going to make this -10. Japan also crazy. And Germany, has joined the let's spend it all party, and we'll figure about it, or we'll think about it tomorrow. Not good for us. But obviously, from a risk appetite, we love this kind of pictures, and we sort of position for them accordingly. Geopolitical risk, been a mess for a while, so let's rush past that very, very fast. To bring it together, we really long to go back to the periods we saw in Q4 2020, when the macro environment was a score of 1 and encouraging us to take overweight towards growth assets of 5. Right now, the macro score is all around -1, which is saying whatever you do, keep an underweight exposure of 5%. And you can see the score there, -0.84 in total, and it is a headwind to growth asset exposure. So the macro is pretty much discouraging risk taking. Now let's move on to pillar number 2. And here the story is the good, the bad, and the ugly. The good, the bad, and the ugly. The good part is that there's about 10 regimes which are entering a sweet spot, which we like. I talked about the global growth tax regime. It's inflected quite nicely, and I think it might create a pro-growth environment for the next 3 months. The gold regime, we've been on this for a while. Duration risk, I'll give you a snippet of how that looks like. The dollar cycle, let's go past that. We talked about it. Global commodities, I'll give you another snippet. SA terms of trade, I'll give you a slight snippet. China consumer one, I'll spend a lot of time. The rest of them are just good examples. So from a regime perspective, these things have inflected quite nicely, and we have taken position in your portfolios accordingly. So if you look at South African bonds, for example, if you look at the average real yield in SA bonds all the way from 1900 to 2024, about 125 years in total, the average real yield for nominal bonds is about 2%, and the average real yield for inflation linkers is also about 2%. And then for cash, it's about 1%. And then if you look at where we are today, ILBs are sitting at 5%, which is double the long-term average for both 10-year and 15-year. So this is such a juicy real yield, and you want to lock it in because these are sometimes once-in-a-lifetime opportunities. If you move over to nominals, where again the real yield is about 2% in the long term, some of them are approaching 8%, really, really juicy. And that explains why we're not going to give up on duration risk at such great levels. We are very, very aggressively exposed to South African duration risk. Global commodities, there's only 4 times in the past when they've been this depressed. 1, 2, 3, 4. In all 4 scenarios, there was poor investment in supply. Financial assets were looking extremely expensive, and the global macro environment was inflationary. I showed you the global macro environment. It fits in all those 3 criteria. And essentially, you've got an environment that is very good for platinum and gold. And we really, really love that about global commodities. So we think we're about to enter a beautiful inflection point. It's been very messy, like I mentioned, but we are very convinced nonetheless. Look at global miners. The return on equity has shot up. It's looking really, really juicy. And you would know that between buying the metal index and the miners, we still love the miners because we think that they are generating are very healthy ROEs and very, very good cash. And you saw from the performance, it's playing out nicely for us. South African resources are part of the global commodity cycle. The historical earnings, the forward earnings, the dividend yields have been declining. This has been a prolonged decline. Fortunately, the ROE is hinting that they've hit a bottom and they're about to recover. So there was this nice shoot up last quarter. Messy, it came back down to critical levels, but you cannot hide from the fact that this is at a good inflection point, and hence we love commodities. South Africa, in terms of trade, very strongly connected to gold and platinum. They've increased quite nicely, meaning that the fundamental support for the rand is very elevated, and normally currency strength feeds into a decline in bond yields. So all of a sudden, this is pointing to a stronger rand, all else equal, and this increases the probability that we unlock those juicy valuations out of our duration risk call. Finally, on Chinese consumer, you would know that in 2008 or 9, the reason why we went through the global financial market crisis is because American investors started to believe that the housing market would never crash in the same way that they believe technology will never crash today. They went to town, borrowed a lot of money, and bought houses left, right, and center. American banks started to create a lot of credit notes based on the housing market, again, thinking it will never, ever crash. And guess what? It did. The blue line then was US housing market, and then the red line would be the loan outstanding. So all of a sudden, everyone was owing a lot more than the assets they held, and they became bankrupt. And this is what we called a balance sheet recession. China has gone through the same story now, where the loans are significantly higher than the houses. I mean, they've got loans worth $1.5 trillion, but the houses are now worth only 500 million 500 million or something like that, or a 1/3 of 1.5 trillion, whatever that number is. And the point I want to leave it is that there's a $1 trillion hole in the balance sheet of China because of this housing market, and hence the reason why it's been on the downturn for a while. The good news is that when you look at the amount of deposits that Chinese have put into banks, as they were going through this housing market crisis, they were no longer buying houses. They were starting to put their money into the bank, and the blue line has been shooting higher and higher and higher. You know that the more banks you have in your banking system, the more you depress your bond yields. So Chinese bond yields have been declining. So this has been a mega bond bull market of not, because of extremely high deposits, which are now sitting pretty much at 5 trillion. So the individual time deposits is your left axis or left side, $5 trillion, which is, I think sometimes some people are saying this is the size of the Japanese economy. I don't really know, but $5 trillion is a lot of money to be left in the bank doing nothing. And even if you say there's a $1 trillion hole here, it can be covered 3 times by the amount in deposits. So the Chinese consumer is not bankrupt. They're just afraid of spending too much money. And you can see because of that, the equity market has not been doing well until this recent inflection, which I talked about a lot. And this inflection is about to enter bull market territory. The most selfish way you can do this is that the extent to which they can draw down on these deposits is the extent to which this market can remain bid on the upside. Then from this context, if you believe our story, the 10% allocation we're gearing towards becomes something you sort of want to do quickly enough so that you don't miss out on a lot of that. So that's pretty much why we're very bullish on the Chinese consumer story. We also know that the USA was in a similar state in 2009 and 2010. I already shared with you that story. Can you see how long it took for them to fix consumer confidence? Almost 4 years. And guess what? That's about the same time Chinese consumers have struggled to fix depressed consumer confidence. When someone's balance sheet is destroyed and they're broke, well, in the sense that their assets are less than liabilities, it's difficult to convince them to spend. But if you get it right, which is what China said they want to start focusing on, this long run in a recovery of consumer confidence typically lasts about 10 years, and the Chinese one is not even started. And voila, we are very bullish on Chinese equities again. I'm not going to take you through all of this because, as you can sense, I'm now running for time or rushing for time. But these are the different pieces where the government of China has been communicating that they now want to advocate for aggressive consumer confidence recovery. And they've prioritized this lack of confidence as a security risk. and they want to address it urgently. And if they get it right, we're probably going to see a 10-year consumer confidence recovery cycle, such as we saw in the USA. And remember, we are a macro regime-based asset allocation house. We allocate to regimes that are looking sweet and good. And this is pretty much why we love this particular story. And then the bad part of the macro regime picture is that the stock to bond market ratio, which when it turns negative signals a recession, when it turns positive, it signals an expansion. And historically, it's been a very good way of getting a sense of where the business cycle is. It's not resting in good territory. And given all the other arguments I made, we would consider this as bad, but we won't call it ugly because it could have been a lot worse from current levels. Then finishing off with the ugly, the 10 versus 2-year, not looking good. The 10 versus 3 months, I know I talked about this with a different visual, so I'm just repeating myself here, not looking good as well. And then the Fed swap not looking good, real rates not looking good. So you can see that the recession signals are saying be very careful. So it's a sweet and sour where there's good things we're positioned for, but there's these ugly things which are forcing us to hold on to DM IOBs, DM bonds for a lot longer than we would ordinarily want to. So if you see us with a lot of exposure to DM bonds in your portfolio, please don't push us out. It is for these ugly scores that you need that recession risk hedge or else equal. And you can see the bond market signal had improved to 0.7. We got a little bit excited. It started to deteriorate again on the back of tariff wars and the Fed not cutting quickly enough, and it continues to deteriorate. So we're not really comfortable. So this again is not a good picture. Finally, when your recession risk signals are flashing red, you either want your rates to be cut, but here will not ease. You want the labor market to weaken, but here will not ease. You want government to spend more. They're starting to spend a little bit more, but because all of these three areas are not working, the only other relief valve left is the US dollar. And for that reason, we think that we may see prolonged dollar weakness until these areas start to help, and so far they are not. And that, I think, comfortably takes us into the currency risk pillar, where you can already see that the environment is pushing for a weak dollar. At a time when the rand is super cheap and the dollar is expensive, you don't want to be holding too much dollars. So we're very bullish on the rand. You also saw how South Africa's terms of trade are looking great, which means we are unlikely to be underweight South African assets from a pure currency risk management. We also look at the fundamentals of the rand relative to China, Europe, Japan, UK, US, based on these 12 fundamental measures. When there's a lot of green, it means South Africa's fundamentals are better. And when there's a lot of red, it means South Africa's fundamentals are weaker. You can see that green is dominating this chart, meaning that the rand is cheap, but there's a lot of fundamental support for it to strengthen. It has started strengthening. We expect that to continue because the fundamentals are justifying that. And you can see that the fundamentals for the South African rand, if you look at this visual, have been looking good. So our view here is that don't take chances against the rand. It will backfire because it's got a lot of room to improve, and hence that neutral South Africa exposure I talked about earlier on. If you then say if the rand is to go back to fair value versus DM markets, what kind of losses would we suffer? A lot of red here means that you're looking at double-digit losses, and the only area where you are safe is the Japanese equity market rather, and that explains why we are there, but everywhere else you can get your fingers bent. And then if you look at it from an overall DM perspective, the losses are between 10 and 20%. We want to avoid that. Relative to the dollar, the losses are worse. They're between 20 and 30. We also want to avoid that, and we have in the way you are positioned. And then if you look at it versus emerging markets, the losses are a little bit better. I mean, you're looking at 7% or 4%, not so bad. And we love that China has got the cheapest currency. It vindicates our core there. India is the most expensive for one-off around alongside Mexico. But generally, the picture here and where our risks are is not a concern for us. So we're happy with our EM exposure. So overall losses are between 0 and 10, better than 10 and 20, but a loss is a loss. And versus the major currency being China, things are looking a little really good. So we're very happy from a currency perspective. The dollar, sadly, there's a lot of red or some red, the numbers are not meaningfully above zero. It's 0.5 overall, meaning that there is no longer enough fundamental support for a strong dollar, which you can see that it has been declining. So we expect that dollar weakness to be prolonged, as we mentioned earlier. And if you look at a US investor trying to buy into other DM currencies, they're looking at very healthy gains, meaning that everywhere else is cheap but the USA. And then if you look at how much money they can make as an American investor buying into other DM, there's quite a lot of gains they can make in the range of anything between 10 and 20. They've started to make those gains, but they've got a long way to go before they get to zero, meaning that you'd rather be in global X USA as far as currencies is concerned. And you can see the numbers here are looking very, very good in that regard. Same when you look at it versus emerging markets. So I'm going to skip this part because I feel you get the message. And then obviously 91 has also joined the party of Orbis. They've joined the party of PSG. And they're pretty much saying that the conditions by which we can experience a weak dollar are strongly in place. And those conditions are these four little dots, which is geopolitical risk is too high. Investment flows into the US are getting exhausted. Rate differentials in favor of the USA are getting exhausted. And the dollar becomes the only source of relief. So we have 4 points playing out so far, which means that we may see a prolonged dollar cycle, and we are positioned with an understanding that we need to position for a weak dollar regime or else equal. But you saw how the global commodities have been very messy in catching this trade. So we're being very careful there, or else equal. So that's our currency story. Valuation story, it's just the same, to be honest. Like, I mean, you've got the developed markets where the orange line being price is so detached from earnings that it's looking very expensive. Profitability has peaked. It's not getting worse. It's not getting better, but the price thinks it's going to go higher. That's a bit of a concern. And when you look at it from a valuations perspective, you're getting scores of -3. I'm going to skip the rest of the valuation picture because I want to catch my time, and the charts are self-explanatory, but I'll sort of close off and say, when you look at the valuations picture, you get this negative skew again, where there's a little bit more things with heavier index weights on the negative than they are with positive. So yes, we've got 3 positives, but the index weights of these ideas are too tiny. You've got a lot of heavy index weight ideas that are skewing this thing on the negative side. So the risk return picture here is skewed to the downside, as I would have mentioned earlier. So that's it with valuations. I'm now closing this. I think you can have a breath of relief because I think I only need 5 minutes to close. So let's close off with the geographical allocation. So I took you through pillar 1. I had nothing nice to say. I took you to pillar 2, the good, the bad, and the ugly. But the fact that I had something to say on the bad and something to say on the ugly suggests that the skew here is negative. I showed you the currency risk. There's a bit of relief from the dollar weakening because everything else is too heavy and the dollar is becoming the stabilizer or the equalizer. I showed you valuations too many, a lot of neutrals, but the heavy index heavyweights are expensive. So the 4 risk factors are not looking good. And if you look at these geographical regions and you take the macro score, which is the orange one, and you add the business cycle, the blue one, you bring in valuations, which is the yellow one. I know this is not yellow, but I think you get what I mean. And then if you finish off with currency risk, you see that from a Q3 score perspective, man, this global picture is too negative. So you actually want to stay in China maybe, and South Africa is the cleaner of the dirty shirts in the laundry basket. So you kind of don't want to be underweight South Africa because, I mean, where are you going to take the money to? And you get a sense that if you're going to take money out of South Africa, your better bet is China and Japan. You already know where we talked about these 2 ideas earlier on. If you put it in a visual context, the opportunity to take money overseas has just been deteriorating gradually, and it's now at its worst. And the only 2 areas which are sort of looking good is Japan, which is the green one, and then China, which is this one at the top, whatever color that is. And then if you just finish off from a visual, there's really not a lot of opportunities to take money overseas. So again, we are hesitant of becoming underweight South Africa for this particular reason. And then if we go on to equity building blocks, which is your investment style posturing, again, if you bring in the 4 factors and then you look at the areas in gray Q3, you cannot see a positive sign. You're not blind, you're right. Everything is negative. It's more negative offshore than local, but it just means there's no place for opportunities here. The investment styles are generally looking very expensive and they're all in the negative territory. When things are like that, we don't take style bets. So you're not going to hear us taking style bets with the exception of one, which I'll close off with. And then if you look at how it looks like, it's really not looking good at all, but you can tell now I'm in repetition mode. And then from a manager conversation perspective, maybe there's interest in value managers and small mid caps. They typically benefit very well from a weak dollar. And we also still like our duration risk ideas, but we've been talking about this for a while, so I'm not going to take any time of your time here. And then if we then finish off with portfolio positioning, you remember this particular slide. So I'm not going to take you through this. We are positioned for option 1 and option 2. And then if we bring in these 4 factors at asset class level, you get a sense that there are very few things that are positive. Right now, the only positive is South African bonds, low duration risk and high duration risk. Everything else is negative. And what you like is typically the cleaner shirt in a laundry basket with dirty things. And you can see only 2 ideas that are flopping at the positive, which is your South African fixed income, South African equity. Everything else, you're pretty much choosing the better of the worst, actually. So not a good picture at all. Same if you go granular, you're going to come to the same conclusion. And it brings you to this positioning, which I'm not going to explain because I did say that I'll just flash through this when I get to the conclusion. So this was my beginning, and it also is my ending. It's 13:25 on the dot. I do apologize. There's 1 or 2 slides I skipped through, but the visuals are quite clear. So you will get, I think, the slide deck from Olga, most likely this afternoon or tomorrow. But essentially, I'm going to close on this note to say we are very careful around the DM side. We are neutral everywhere because of the impact of China's policy inflection, and we love our duration risk. We love our China. We love our gold. And that has been a story that's been well rewarded over the last year, well rewarded over the last 2 years. And if we keep up at this space, also very much well rewarded over the last 3 years, which would mean that if our calls continue to be supported well, your 1 year, 3 year, 5 year, 7 year numbers are going to be looking great. And we're generally quite proud of the outcomes. Thank you for giving us this opportunity. We will have this conversation, but this time around, focusing only on your portfolios, as we have already started our client-on-client investment committee meetings with you. Thank you so much. Have a great afternoon.